You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Welcome to the show, Bob.
Yeah, Jim, good to be with you. Good to be here. It's Friday.
The equity markets, the best of times, the worst of times. Well, I must say the most interesting times.
You know, I was talking with one of my friends who's been in the business almost as long as I have, and a very successful trader, got a good eye for things, and we both agreed that for anybody to be in and paying attention to the financial markets now is a privilege, because it is the most extraordinary times in financial history. Oh, in the past you've had governments go crazy in the financial markets. Mainly it was the old printing press, inflation. Everybody knows about the Weimar Republic in 1922-23, or what you had in banana republics at any time in any century. But you've never had let's call it the central banks in senior, well-established countries trying to do the equivalent of printing currency and doing it through the credit markets. And it is the most astounding effort in all of financial history. And there have been many experiments by governments, and there's nothing been to this degree. And one is tempted to say that they're insane, but I think a more appropriate word is that they have become fanatical, that their manipulations will always prompt nice business expansion and unemployment. Of course, we know in the United States the unemployment percent has dropped down, but it's an absurdly manipulated number. It doesn't look after all the number of people that have dropped out of the workforce, or the percent of number of people that are working compared to those that could be working. So and I think, they had a Gallup poll last week come out and said that it was the calculation of U.S. unemployment was a lie. And we all know that they've been lying about the consumer price index since Clinton administration. And so and then now we're up to this where they are bound and determined to prove that their theories of intervention are sound, and what they're doing is extremely unsound things. And the Swedish bank this week lowered their administered rate to minus, and part of the report on that was that they were concerned about people hoarding money. And I immediately thought, when was the last time we have had concerns about that? Of course, that was the 1930s, when money was worth something and the prices were falling, so people hoarded money, and the Roosevelt administration went insane on that one. So we are in, Jim, very exciting times financially.
My wife wishes I was a money hoarder.
Well, then what happens next here? In engineering terms, it is a positive feedback mechanism where every up adds more up forces, and corrections are not allowed. They're just plain not allowed. And of course, at the same time, the experiment going on with authoritarian government in the United States, the normal checks and balances of society are, you've got the judiciary, you've got the legislative, and you have the legal side. I mentioned that, and the media. And there was 4 things in there that were all supposed to check and balance each other, but they've all become united in big government. And it's distorting things beyond anything seen in over 400 years. And this is where I emphasize that those of us who are looking at it and watching it, it's a privilege to be actually participating in this rather than reading about it in an old history book. So where is it going to go? Well, they keep adding more to the trend. It's not allowed to correct. So it's kind of like what they do with the forest. They don't allow any cleanup of the forest base. They don't allow forest fires. They try to suppress them. And then eventually when one gets going, it becomes a major conflagration. So here we are. It's a conflagration of idiosyncrasies out there. And so we now got the S&P to new highs. it's at a favorable time of year for stocks. We had one come in here a week ago. We noticed that the Treasury bond had become very overbought, and it is part of a flight to quality, and that you had some recovery going on in the junk bond price because they got down to very oversold in December with the pressures on crude oil. So here we are, and it's back on to risk back on now. You've got Treasuries down, you got junk up, and you got the S&P to new highs. So it'll continue, but it's building. It's all becoming very precarious. In a normal financial bubble like 1929, it did come apart. But what you have here is that it's just not really allowed to come apart. These guys think they can manage the world. But at any rate, it'll continue because the central bankers who are acting in a very speculative fashion need speculators out there to bid asset prices up. And as we've seen over the last few years, you've had a bear market for commodities since 2011 in the face of tremendous recklessness in central banks. And that's because the public chose not to speculate in commodities, but chose to speculate in stocks and bonds. And so at some point, stocks and bonds will get so overpriced that they'll correct on their own. And let's remind ourselves of 2011, where gold and silver got so overpriced they had to come down. And then that's when the shift changes to buying stocks and bonds. So it's all very overpriced, highly speculated in, and it has legs of its own, and it's going to run for a while yet. Wrote yesterday on the S&P, or the NYA, the New York Stock Exchange Composite, which is a really good broad index of stocks, that it was above the 50-day moving average, and if it stayed above, things were positive, and it's above there, and now the S&P's made new highs. So we're content to let this run, but we're also aware of some of the problems that is being built in this whole precarious financial engineering. And remember that in Japan in 1989, their central planning body was called MITI, M-I-T-I, and as long as their bubble was going up, the reporting world thought that they were the best policymakers in history. And then it crashed. And at the end of 1989, there was nothing that was going to ever break that boom, but it got overdone and crashed. So here we are now. The world is thinking that all of these policymakers are absolutely brilliant, and they want it to go up, so therefore it will go up. But at some point, it breaks. And again, I'm going to emphasize again, if commodities came down with easing like they have now, so can stocks and bonds once they get overdone. So on commodities here, the crash in crude oil prices was likely to run for 6 or 7 months. That counted out to January. Came down to a pretty good low at the end of January. It was at 44. And then the world gets on board because they think that it's going to be a V bottom. So you got to buy right now. And they jam it up, and then it comes down. So it was doing like 6% moves in one day, 6% up in one day, 4% down the next day. And so we think that, again, from history, that after a crash in crude oil, it can take 2 to 3 months before it actually stabilizes and then sets the next uptrend. The shortest one was 2 months. So anyways, the crude is building a base for a potential rally at some point. This has brought in some support for other commodities, such as the grains and base metals. But they can firm up for a while, but we don't see any new bull markets for most commodities. But what we do see for the precious metal side is the possibility of a new bull market here. And this one, we should go back to, I guess it was November when I did the big study on gold and explained how it works in real prices and in post-bubble contractions and stuff like that. And what we needed on the near term through December and January was to see the price of the gold stocks beginning to outperform the bullion price. And we got that. Then the other side of that would be to have silver beginning to outperform gold, and we've had that. So the precious metal side is making a good bottom in here. The advice has been to accumulate some of the gold stocks on weakness, but we're not fully invested yet. Just let this thing dither around for a while. But we've got a wonderful lead on the real price of gold, and as we measure that by gold divided by commodities, and it ended its cyclical bear market last June and has been recovering ever since. It's in a good, strong uptrend for the right reasons, but gold has been outperforming all other commodities. And this represents improving operating margins for the gold miners. I mean, if their costs of energy, think crude oil, are down, and if their cost of mining equipment is more available at a better price, think of all of the low prices for base metal miners. And then there's also a lid on wages, too, if you're getting base metal mines shutting down. So it's way gold works in a post-bubble contraction, and it's working the right way, and we think that the bull market for gold's real price will eventually pull the gold miners up into a new bull market, and that might take 4 or 5 weeks work yet. So we like the golds. Bonds and stocks are precarious, but the stocks could be firm for a while yet.
We'll have more with Bob Hoye right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking to market historian Bob Hoye. What about the currency markets, Bob? The U.S. dollar continues to be strong, and I was asking a currency expert about the value of the Canadian dollar, and he said, it really isn't doing that bad. It's just compared to the U.S. dollar.
Yeah, currencies are very critical here. Historically, once you're past a bubble, the senior currency has become, as I've used the phrase, chronically strong against most other currencies and against most other commodities for most of the time. So that's the way it works. One of the arguments for this mechanism is that during the bubble, there's a huge amount of debt issued, and if it's issued out of New York, the financial center, then it's due and payable in New York, which then debt service becomes a huge short position once they decide that they got to start paying it back instead of borrowing it all the time. So that's one thing that helps keep the dollar firmer, and it's of course going to be very frustrating to the Federal Reserve because they live for dollar depreciation. So here, but then the Canadian, of course, came down because, unfortunately, it was labeled as a commodity currency, and it fell down to 77, which is a horror show if you're a Canadian consumer. But it became extremely overbought a week ago. We have a proprietary model that we call it when the decline gets severe enough, it's called a downside capitulation, and then you run it on the weekly, daily, and monthly. And last week this came in all 3 readings, so we called it a trifecta buy on the Canadian dollar. So the dollar can bounce. This doesn't mean to say that there's going to be very strong commodity prices. It's just that it got so murdered on the way down.
So there's still hope for the loonie.
Hope for the loonie, hope for the toonie, and, I don't know what you think, Jim, but when the dollar Canadian was very close to the U.S., it made you feel good. You could buy stuff without having to pay up too much. And then it started coming down, and then the Bank of Canada did that final rate cut, which was absolutely not needed. If you got the price of crude oil dropping 40%, another percent drop down in the Canadian dollar is not going to help the producers in Canada export their, it's just, Don't get me going on the theories of intervention, and we'll just leave her there.
Okay, you won't be putting that on a T-shirt anytime soon in favor of intervention.
Yeah. Well, I may not agree with what your T-shirt says, but I would defend unto the death your right to wear that T-shirt.
Thank you very much, John Wayne.
Good one.
Okay, thank you very much, Bob. My guest has been market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Their website, institutionaladvisors.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. You can forward questions or comments to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.